trading strategies video, we're going to talk about the long iron butterfly spread. So the long iron butterfly is essentially a way to buy a straddle at a reduced cost, but with that comes less profit potential as well. So let's go ahead and get into the general strategy characteristics, and then we're going to look at a couple real iron butterfly trade examples to show you how the position performs in various scenarios. Alright, so the long iron butterfly is the same thing as buying an iron butterfly, and this strategy consists of simultaneously buying a call and put at the same strike price, or a straddle, while also selling an out-of-the-money call and out-of-the-money put against the long options. So you're essentially buying a straddle and selling a strangle against that straddle. Now another way to interpret the strategy is the combination of a long call spread and a long put spread. So however you want to interpret the strategy, either way is fine. So the maximum profit potential of the long iron butterfly strategy is the width of the wider spread minus the debit paid times 100. Now at expiration there are two break-even prices for the long iron butterfly, and the upper break-even price is equal to the long strike plus the debit paid, and the lower break-even price is equal to the long strike minus the debit paid. Now the estimated probability of profit for a long iron butterfly spread is theoretically less than 50%. And that's because you need the stock price to move, and if the stock price does not move, then you're going to lose money from time decay. So that time decay works against you and reduces your probability of profit. Now, there are some instances in which the long iron butterfly spread could have a higher than 50% probability of profit, but for most structures, the probability of profit will be less than 50%. Now the resulting position after expiration depends on if one of these spreads is entirely in the money or if only one of the long options is in the money. So if an entire spread is in the money, then there's no stock position after expiration, and all that will happen is that you'll be charged exercise and assignment fees if you let those options expire in the money. Now if only the long call is in the money, then the position will expire to plus 100 shares of stock per long call, and if only the long put is in the money, the position will expire to negative 100 shares of stock per long put. Now in regards to assignment risk, the long iron butterfly strategy does have a short call and short put component, so there is assignment risk if one of those options is in the money. If the short call is in the money, the assignment risk is negative 100 shares per contract, and if the short put is in the money, the assignment risk is plus 100 shares per contract. Alright, so now that we have the characteristics under our belt, let's go ahead and look at a hypothetical example and then look at the expiration risk profile graph. Alright, so let's look at a hypothetical long iron butterfly trade from the following option chain. So at the time of these option prices, let's say the stock price is trading at $300, and we think the stock price is going to make a significant movement either up or down, but we don't know which way. So to construct our iron butterfly, we're going to buy the 300 put and the 300 call, and then we're going to sell the 250 put and the 350 call. So you can interpret this as buying the 300 straddle and selling the 250 350 strangle, or you can interpret it as buying the 300 250 put spread and the 300 350 call spread. Same thing. Now we're going to pay a net debit of $22.94 for this trade, and with that said, let's go ahead and see what the expiration risk profile graph looks like. Alright, so as we can see here, we have our long call and long put struck at $300, and then we have a short put at $250 and a short call at $350. So on the previous slide, we determined that we paid a net debit of $22.94 for the spread. Now as we can see, if the stock price is right at our long strike of $300 at expiration, our loss is $2,294. Now that comes from the $22.94 debit paid times 100, which comes out to $2,294. Now if you're wondering why the maximum loss occurs at that price, it's because if the stock price is right at $300 at expiration, then the short put, short call, and the long put and long call will all expire worthless, and basically, since we paid a debit of $22.94, if all of our options are worthless at expiration, we lose that full debit paid. Now as we can see here, our break-even prices are $277.06 and $322.94. Now that comes from the long strike minus the debit paid and the long strike plus the debit paid. Now if the stock price is right at $277.06 at expiration, then all options will expire worthless except for that long 300 put. Now, if the stock price is at 277.06, that long 300 put will be worth $22.94 at expiration. And since we paid a net debit of $22.94 for the entire spread, we'll break even on the trade. Now, the same is true if the stock price is at 322.94 at expiration. So if the stock price is at 322.94, that long 300 call will be worth $22.94, while all of the other options will expire worthless. And therefore, we will break even on the trade since we paid $22.94 for the entire iron butterfly. Now, our maximum profit potential is $2,706 on both sides of the trade. Now, that's because we have a $50 wide put spread and a $50 wide call spread, and if one of those spreads is entirely in the money at expiration, then that spread will be worth $50, and since we paid a net debit of $22.94 for the entire package, our profit will be $27.06 for the iron butterfly, which comes out to an actual profit of $2,706 per iron butterfly. So in this case, both of the spreads are equidistant, and they're both $50 wide, so we have the same profit potential on both sides. So as you look at this graph, you learn that a long iron butterfly strategy has both limited loss potential and limited profit potential, and to profit, you need the stock price to move up or down beyond one of your break-even prices. Alright, so before getting into the specific trade examples, let's go ahead and talk about a long iron butterfly's Greek exposures so that you understand how the strategy is expected to perform before it expires. So the following Greeks assume that the stock price is near the long strike price. Now that's because if the stock price is either way above the long iron butterfly or way below it, then these Greeks won't really apply. So the following Greeks assume that the stock price is near the long strike price of our trade. Now, let's start with delta. Now, a long iron butterfly typically begins with a delta near zero if the call spread and put spread have offsetting deltas. However, an iron butterfly can be structured directionally and will become directional when the stock price shifts up or down. So, since a long iron butterfly is technically a market neutral strategy, the delta will start right around zero in most cases. Now, in regards to gamma, a long iron butterfly has positive gamma, and that means when the stock price rises, the butterfly position will become more long because its delta will get more positive, and when the stock price falls, a long iron butterfly position becomes more short because the delta becomes more short. Now, to make sense of this intuitively, we know that when we buy an iron butterfly, we need the stock price to either rise significantly or fall significantly. Now, if the stock price is right at our long strike price and begins to rise, we obviously want that movement to continue so that we can make money on the upside of the trade. Now, that's going to be expressed by a positive delta. Conversely, if the stock price is right at our long strike and begins to fall, then we obviously want that movement to continue because then we can make money on the trade on the downside, and that will be expressed by the spread's negative delta. Now, in regards to theta, a long iron butterfly position has negative theta. Now, that's because as time passes, the extrinsic value of options decays over time, leading to decreasing option prices, which is bad for iron butterfly buyers. So, if the stock price is right near our long strike price, you'll know that the long options have much more intrinsic value than the short options in the strategy, and therefore we have more extrinsic value to lose if the stock price remains near our long strike. Now, that's especially true near expiration, as at-the-money options decay very quickly as expiration is approaching. So the passage of time when the stock price is near our long strike is not a good thing. Now, lastly, Vega for an iron butterfly position is positive. Now, that means that increases in implied volatility indicate an increase in option prices, which is what you want when you buy an iron butterfly. So since you own those at-the-money options and you're short those out-of-the-money options, an increase in implied volatility will benefit those at-the-money options more than the out-of-the-money options, and you're expected to make money. Now, on the other hand, a decrease in implied volatility indicates that option prices are falling, which is obviously bad for iron butterfly buyers. So if you buy an iron butterfly and volatility contracts, then you're going to lose more money on those at-the-money options than you'll make on the out-of-the-money options. So net-net, you're expected to lose money when implied volatility decreases. Alright, now let's dive into some real example trades so that you can see how an iron butterfly position performs as the stock price changes over time. So the first one we're going to look at is a break-even iron butterfly. So here's the setup. The initial stock price is 105.79, and to construct our iron butterfly, we're going to buy the 106 call and 106 put, and then we're going to sell the 97 put and 112 call. And all these options expire in 45 days. Now we're going to pay a net debit of $4.42 for this trade, and that's going to bring our upper break-even price to 110.42, which is the long strike plus the debit paid, and our lower break-even price is going to be 101.58, which is the long strike minus the debit paid. So we actually have different profit potential on the upside and downside of this trade, and that's because we have a $6 wide call spread and a $9 wide put spread. So if the stock price is above our call spread at expiration, our maximum profit potential is $158. And that's because we have a $6 wide call spread minus the $4.42 debit times 100, which is $158. Now on the downside, we have a $9 wide put spread, and if we subtract $4.42 from that and multiply by 100, we get a max profit potential of $458. So as we can see here, since the put spread is wider, we do have more profit potential if the stock price decreases. So in this case, we would say that this long iron butterfly has a bearish bias because you'd rather have the stock price decrease than increase. Now, as always, our maximum loss potential is the debit paid, which comes out to $442 in this case. So let's go ahead and see what happens to this position over time. Alright, so on the top part of the graph, we're looking at the changes in the stock price relative to our iron butterfly strike prices and break-even prices. And on the bottom part of the graph, we're looking at the changes in the iron butterfly's price. Now, as we can see here, the stock price does remain around the strike price of 106 for a good duration of the trade. And on the bottom part of the graph, we can see that the iron butterfly actually does lose value over that period, and that's from that time decay. So those at-the-money options are losing more value than the short options. So net, this trade is losing money. Now at expiration, the stock price is right above our upper break-even price of 110.42, and that means we just break even on this trade. Now with the stock price at 110.42 at expiration, the short 97 put expires worthless, the long 106 put expires worthless, the short 112 call expires worthless, but that long 106 call expires with a value around $4.42. Now, if you recall, we purchased the entire iron butterfly for $4.42. So, since one of the options in the strategy is worth $4.42 at expiration, we break even on the trade. Now, if this position was held through expiration, then this trader would buy 100 shares of stock at the strike price of 106. Now that's because that long 106 call expires in the money, while all of the other options expire worthless. So if you hold a long call through expiration and it's in the money, then you're going to buy 100 shares of stock per call contract at the strike price of the option. So if you did not want a stock position after expiration, you would have to go ahead and sell that long call before it expires. Alright, so example trade number 2. Let's look at a maximally profitable iron fly. So here's the setup. The initial stock price is $74.44, and to construct our long iron butterfly, we're going to buy the 75 call and 75 put, and we're going to sell the 70 put and the 80 call, with all the options expiring in 39 days. Now for this, we're going to pay a net debit of $3.47, and that means our upper break-even price will be $78.47, and our lower break-even price will be $71.53. Now our maximum profit potential on this trade is the same on both sides, since both the put spread and the call spread are both 5 points wide. So our maximum profit potential on either side of the trade is $153. Now our maximum loss potential is the $3.47 debit times 100, which comes out to $347. Alright, so again, in the top part of the graph, we're looking at the changes in the stock price, and in the bottom part of the graph, we're looking at the actual changes in the price of the iron butterfly. So in this case, we have that 75.80 long call spread as part of our long iron butterfly, and as we can see here, the stock price expires above that call spread at expiration. Now that means that that long 75.80 call spread expires with a value of $5, and the long 75.70 put spread expires worthless. So the net value of this long iron butterfly at expiration is $5. Now we can see that on the bottom part of the graph. Now since we paid a debit of $3.47 and at expiration the position was worth $5, we realized the maximum profit potential of $1.53 per spread, which comes out to an actual dollar profit of $153. Now since that entire long call spread is in the money at expiration, you actually wouldn't have a stock position if you let those options expire, because that long call and short call would offset each other in terms of stock positions. However, if you did let those options expire in the money, you would be charged exercise and assignment fees from your brokerage firm, so that's always something to keep in mind. Now most of the time it'll be cheaper to just close the options before they expire, but in some cases if you're trading a large number of contracts, letting those options expire in the money and then just getting charged the exercise and assignment fees is sometimes cheaper. Depends on how many contracts you're trading. Alright, example trade number 3, a large loss iron fly position. So here's the setup. The initial stock price is $752, and to construct our long iron butterfly, we're going to buy the 750 put and 750 call, and sell the 625 put and 875 call, with all those options expiring in 46 days. Now we're going to pay a net debit of $66.15, which brings our upper break-even price to $816.15 and our lower break-even price to $683.85. Now our maximum profit potential in this case is $5,885, and our maximum loss potential is $6,615. So this is a fairly large position. So let's go ahead and see what happens over time as the stock price is changing. Alright, so again, on the top part of the graph, we're looking at the changes in the stock price relative to our long iron butterfly strike prices and break-even prices. And in the bottom part of the graph, we're looking at the changes in the iron butterfly's price. So as we can see here, the stock price starts right around $750 and pretty much remains between our break-even points for the entire duration of the trade. Now at expiration, the stock price is just below our strike price of $750, and as we can see on the bottom part of the graph, the long iron butterfly spread loses value consistently over the entire period of the trade. So in this case, we bought the trade for $66.15, and at expiration it was only worth about $10. Now that's going to represent a loss of $56.15 per iron butterfly spread, or a loss of $5,615. So this is a fairly large loss, and this demonstrates that when you buy an iron butterfly spread, if the stock price is right near your long strike at expiration, you're going to incur near the max loss. Now in this case, all of the options expired worthless except for that long 750 put. So since that long 750 put is in the money at expiration, then this position would expire to negative 100 shares of stock, or a short stock position, per long put. So if you did not want a short stock position after expiration, you'd have to go ahead and sell that long put before it expires. Alright, so let's go ahead and recap the summary of main concepts. So buying iron butterflies is a directionally neutral strategy that consists of buying an at-the-money call and put spread with the same long strike price. The position can also be thought of as a long straddle combined with a short strangle to limit the risk. Now the main profit drivers when buying iron flies are large stock price movements in either direction or increases in implied volatility. Now to close a long iron fly before expiration, a trader can simultaneously buy back the short options and sell the long options in one transaction. Now closing the trade will lock in any profits or losses you have at that time. And lastly, though a long iron fly generally begins as a directionally neutral strategy, the position will become directional when the stock price trends in one direction. More specifically, a long iron fly becomes long when the stock price rises and short when the stock price falls.